Thanks everybody for attending our workshop this morning, or the current issues session. This morning we decided a few weeks ago to discuss the current situation, comparing it to the 2008 time period of our economy. And Larry Sanders graciously approached the subject and said it was a great idea, or brought it up. Anyway, let's go ahead and again, thank you for attending. Our next session will be in November. This was a special session brought up by Larry. So without further ado, let's go ahead and get started. So Larry, go ahead and crank it up.
Thank you, JC. I am rarely gracious, but good morning, Oklahoma. It's good to be here. Let me just tell you real quickly the way I've attempted to do this is to kind of set the stage. I'll give you a brief overview of where we've been and where we are, and then I'm going to start peeling the onion like I often do, looking at some specific economic issues that tell the story of the 10 years that have passed since the Great Recession occurred in roughly 2008, give or take a year. So without further ado, we'll move right into it. Just to refresh our memories, economists like to look at the tea leaves after something has happened and give some official definition to it. So the official recession period was actually deemed to have started back in December of 2007 and lasted through June of 2009. When most of us saw it actually falling apart was where the country was about to go over the edge in September of 2008, and we felt the impending doom probably well into 2010. The primary cause was a bubble of poorly financed homes. We probably lost $8 to $14 trillion. That's T trillion in the housing market. Most of that was on the coasts and in the upper Midwest. Oklahoma bankers, heartland bankers, tended to be much more conservative, so we didn't feel that quite as much here, but there was a pinch. Worldwide losses were even greatly. I've seen studies that have varied quite a lot, so I won't put a number there, but it's trillions more of dollars where communities, nations that invested in some of these collateralized debt obligations didn't get out with the shirts off their backs and lost a lot of money. So the entire globe lost trillions and trillions of dollars during that period of time. It was no doubt the worst economic downturn we'd had since the Great Depression. But here we are. We are sailing relatively smoothly. The U.S. and global economy has mostly rebounded. The economy of the United States, in spite of a severe hit, has proven to be very resilient. That said, not all is well, and there are a lot of people out there that are still hurting, have not been able to rebound like we would like them to. So let's just kind of start peeling the onion on that. The U.S. economy lost over 8 million jobs during that Great Recession. Consumer spending took a big hit, and we may never recover some of what was lost during that time. Business investment took an even worse hit. Some investment firms that seemed too big to fail aren't with us anymore. Think Bear Stearns as an example. A lot of small to mid-sized firms failed and aren't with us anymore. Some rural areas were forced to accelerate consolidation of schools and hospitals. because they were invested in markets, or the state was invested in markets that lost some of their ability to repay and couldn't come up with the funds to support budgets that we thought would be there. The government, the federal government, basically nationalized some large firms to keep them afloat. Think of General Motors and how it wouldn't be here if it weren't for the federal government keeping it afloat. Took a while to come out, but it did come out on the other end. So this thing that we call the American dream, most of us grew up with as kids. Our parents grew up thinking that they would have it and they would pass it on to their kids, us, and we would pass it on to our kids, so that, you know, when we grew up and got jobs, we'd be able to own a home. We'd have a car or two in the driveway or the garage. We'd have health insurance plans that would take care of us. We'd have good retirement plans that would last us until we were put into the ground. We'd be able to take a good vacation once or twice a year. We'd have savings plans that might help us get our kids at least to the state colleges like Oklahoma State. All of that ceased to exist for millions of Americans. Admittedly, some of it never existed for a lot of marginalized, socially depressed Americans, but those who thought they had it up until 2008 lost it and never regained it, and they'll never get it back. I'm going to try something here, and I want you to see if you can do this on your screens. It's not going to show up on my screen. It's going to show up on a side screen, and I'm going to see if we can walk through this. This is geography of jobs. If you tap on this, you'll go to another internet screen. Some of you have seen this before. It has finally been updated, but it shows a map of the United States, and it's going to show balloons or bubbles, red initially showing the jobs lost, and green showing jobs gained. As we move to the next map, we're going to show that blue is going to replace green for jobs gained. So if you tap the arrow to move to the next screen, you'll see that you've got a geography of jobs that goes all the way back to January of '99. And I'm not going to go back that far, so if you can get your arrow on the screen to slowly move the bar forward to 2008 approximately, January or February of 2008, and just stop it there for a minute, and you'll see that there are a few small red balloons or bubbles around the country, up around the Detroit area, along the coastlines of Southern California and Florida, and a few other areas, but a lot of blue bubbles or balloons, looking like the economy is looking relatively good. And you'll see a guide there that shows you that the small balloons or bubbles show 10,000 jobs gained or lost, and the larger mid-sized bubbles or balloons are 100,000 jobs gained or lost, and the really big bubbles or balloons are 250,000 jobs gained or lost. And so the red is lost and the blue is gained. And if you've got this stopped on a particular month, you can actually move around the country and it'll tell you what's going on here. So you can look down, if you move down to a particular area like the Florida area, it'll tell you that how many jobs are being lost in Florida in January or February, or it'll tell you how many jobs are being lost in the San Bernardino area, Los Angeles area, or it'll tell you how many jobs are being gained up in the Seattle area or in the New York area. So just have the bar stopped up around that 2008 area, and then tap the arrow just to get it started. And when everybody's ready, we're going to tap that arrow and watch what happens to the screen for the next 10 years of those bubbles. And it's going to happen fast. So if you were able to get to this point, and as you watch that, the really dramatic losses occurred in the first couple of years between 2008 and 2010, and by the time we got up here to the 2016 to 2018 area, the economy looked like it had generally recovered. There's a few areas where there's problems, but the economy is looking pretty good. So I'm going to ask you just to go back again and pull that starter bar back to 2008 and start it again. And just let it go for the first 2 years. Let it go into 2010 and just watch those bubbles balloon at all the jobs lost between 2008 and 2010, and then stop it. Okay. You know, it was a pretty deplorable picture of the United States at that point in time. This was a period of time where consumer spending had really dropped drastically. Business investment had dropped even more dramatically. And the only thing going at that point in time was government spending, and we're going to show what that looked like in just a moment. But it just wasn't enough to keep the economy going at the level it had been going before. And so even in the heartland, there were some pretty dramatic job losses going at that period of time. And you know, you can look at Oklahoma City in February of 2010, and there were 18,000 jobs lost. And you can look at Tulsa, Oklahoma, and there were 19,000 jobs lost. And you can look at the Dallas, Fort Worth, Arlington area where there were 71,000 jobs lost. And you know, you can just keep going around the country, and it just wasn't a very attractive picture of the economy. But if you pull it all the way up to you know, 2018, in May of 2018, it looks pretty good. You know, we're seeing jobs gained in Oklahoma City and jobs gained in Tulsa and lots of jobs gained in the Dallas area and in the Houston area. And recovery has occurred. That doesn't mean that it's we're back at the level we were before, but this map shows you that just how much things went down and then came back up. So I'll let you explore that more on your own time. We're going to move on here. So what I'm going to do in the next several slides is we're going to take snapshots of some of the key economic triggers, and we're going to look at talking points that you might consider if you want to share this with some of your people that you might talk to, or if you decide you want me to come out and talk, or some of the area economists could do a good job with this stuff. But if we look at unemployment rates, we're going to talk more about jobs here for a little bit, and the reason we're going to talk about jobs is because we all know, I think now, that more than half of all farms get more than half of their family income from off-farm, from non-farm jobs. So jobs, non-farm jobs, are important to family farms. So that's why we're going to spend a little bit of time talking about that. We've gone from back at those awful times in the height of the Great Recession, where we had nearly 10% unemployment, down to this point where we've been bouncing around just below and just above 4% unemployment. We're down, sitting around 3.9% unemployment right now. A great position to be in for our economy. That doesn't mean that everyone went back to their original good-paying jobs. Few, in fact, were able to regain their original job status. And it took a long time to get to a second or third choice. And some people perhaps even had to go back for retraining, and even retraining didn't help some of those people. These two graphs look at another way of talking about unemployment. One is long-term unemployment, the upper graph. If you consider the orange part of that graph, the orange line, you're looking at those who have been unemployed for 27 weeks or longer, and they represent about 1% of the entire labor force. If you take the subset of the unemployed population, and of that subset, those who continue to be unemployed for 27 weeks or longer, that's the red line, and there's about 20% of those that fall into that category. If you look down below at the red line, you'll see that where we normally show unemployment, as I just did, down around about 4%, 3.9 right now. If you add in the marginally attached people who have looked for jobs in the last 12 months, but may not have looked for jobs in the last 4 weeks, so they don't show up in a survey of looking for work because they may be back at school, or there may be some family reason that they're not showing up on a survey. Those are marginally attached workers, and those who are part-time for some economic reason in the short run. We actually have total employment up around perhaps 8 to 9%. So depends what you're counting and who you're counting as to how bad unemployment really is. So other factors to consider when we're looking at jobs, of course, are wages. That's been one of the big sticking points, one of the problems that people have aired their frustrations about, one of the problems that people were very frustrated about in the last presidential election, is that while the economy seemed to be doing so much better, and you saw in the graph the blue bubbles popping up everywhere and not very many red bubbles anywhere, and the stock market seeming to do so well, there's still a lot of people out there either unemployed, or if they are employed, they're not getting the kind of wages that they used to be getting. Wages continue to lag way behind, and you look at the top graph here, and you'll see that wages are beginning to move up somewhat, but they're not moving up at the same rate that they were before the Great Recession. And there's not any indication that it's going to happen anytime soon. So either the economy has made a serious structural change and we've moved to a different trend line, or it's going to take a longer period of time before we get back to a point where wages begin to move back up at a rate that they were before the Great Recession were. The bottom graph shows that clearly a major reason that employers don't have to pay the wages that they did before is because there's more people looking for work than there are jobs. At one point in time, if you go back to 2010, for every job opening, there were 7 people looking for work. So employers were in the catbird seat. They could pick and choose. And those applicants were begging for work and knowing that they could not get the wages they could before. Now we're back down at a ratio that looks like wages could become more competitive, but we've got some problems where the jobs aren't where the employees or the applicants are, and maybe the skills aren't where the jobs are, and those are the kinds of things that maybe government training and skill training like career tech and others might be able to lend some assistance to. This is a confusing chart perhaps at first to look at, but it shows the average length of time it takes for workers who lose jobs because of a recession to get back in the market. And it shows the last 4 recessions, and the most recent recession is the one that it took the longest. And it's very similarly related to the last one I just showed you, where the ratio of jobs to available applicants, it took 72 months or 6 years for people to begin to get back in the market, for there begin to be enough jobs available for people who wanted jobs for this recession. That's longer than any recession we've ever had on record. And again, these jobs are rarely at the pay scale of previous jobs that they might have had. And this again further emphasizes that point. If I'm overemphasizing it, I apologize, but this just gives you some of the different skill sets, some of the different job categories, and shows that in all major skill sets or job categories, job openings had fewer offers available than unemployed in those categories. The lighter blue or the gray were the numbers of people available, and the darker blue or the darker gray shows the number of job openings. And there wasn't any category where there were more jobs available than there were people available to fill those positions. During that first couple of years of the Great Recession, we put together a map that showed the severity of the decline of total employment, and the darker blue shows the where most employment was lost, and the darkest red, and the lightest red shows where the least employment was lost. And of course, the irony is that where the white areas are is where this Great Recession didn't have much of an impact. So while this was a very severe recession and it had impacts that are still with us today. And it was perhaps the worst economic downturn that it was no doubt the worst economic downturn that we've had since the Great Depression. There were large pockets of the United States that didn't feel the effects like some of the country did. Could be because there's less economic activity there, there's low population numbers there, different reasons for different areas. You've heard this part of my talk before, but I'll just hit the tops of it real quickly. The way we measure the general economy is with the technical term called gross domestic product. And what makes up gross domestic product are three categories: consumer spending, business investment, and government spending. The top chart is consumer spending for the last 10 years. It shows that it took a downturn and we've gotten back on what looks like a trend line, but chances are we're probably not going to make up that downturn that occurred in the first 2 years of the Great Recession. The middle graph shows business investment, and look at the great hit that business investment took during the first couple of years of the Great Recession. We are not quite yet back up to a trend on business investment. Businesses are very skittish about investing in the economy and looking for long-term investments that they can feel confident about. I think once they see the global economy starting to settle out more, maybe they'll enjoy more confidence, and maybe we'll see this begin to turn up. But that's a concern I have about the current economic situation right now. You look at government spending, you see the big increase in government spending in the first couple of years of the Great Recession. The George W. Bush administration, just before it left in the last few months of 2008, put a lot of money out into the economy to try to prevent a worse crisis from us going into a depression. And in the first quarter of the Obama administration, they put another large pot of money into the economy, and those two things kind of counteracted to some extent the downturn in consumer spending and the downturn in business investment. They didn't completely compensate dollar for dollar, but they kind of softened the hard landing that we might have had and probably prevented us from going into a depression during that period of time. But you see here in this government spending chart at the bottom where during the Obama administration with Republican Congress and Democratic presidency, we had a great reduction in government spending for a period of time, and then we began to see an increase again because of some concerns about the economy. And then with the beginning of the Trump administration, there's been a big uptick in government spending again. So that has increased, maybe to overcome business investment. Business investment is moving in the right direction, but maybe not as fast as some people would like. Consumer spending seems to be doing just fine. Okay, two graphs here. The top graph basically shows this GDP gross domestic product. It's in real terms. That means that inflation is taken out of the picture. It shows that it's recovered since the Great Recession, but it continues to be very volatile, but it's moving in the right direction. It's on an upturn. If you look at the bottom graph, and it shows a long-term picture here rather than just the last 10 years, I thought that there was some relevance here because of where we are now, but it shows the ratio of federal debt to gross domestic product. And we haven't seen this ratio this high since 1948, coming out of World War II. And I have some concern as an economist here that this being this high, because if we go into another crisis, a recession, a major military conflict, some other severe situation that requires a major government response, we don't have a lot of slack left to get into that and recover without causing hyperinflation, which could potentially lead to possible depression. So, I would resist calls for more tax cut legislation in the next couple of years, and work at trying to bring this government spending back down to some level here in the next couple of years. But during election periods, you know what happens. So GDP is back on track. You can see the top graph. I've drawn in a dotted green line to show this slack between the dark blue line and the green line, and that's something that shows what we've lost in the economy over the last decade that we're probably not going to get back. We could see GDP really take off and get that back over the next 10 to 20 years, but it's going to take some time. The bottom graph shows the changes in real gross domestic product, and again, real terms means we've taken out inflation in that. It's just going to take a while for us to fully recover from this, but we seem to be on the right track. Think about inflation. We're beginning to see signs of inflation coming back. The Federal Reserve System, I think, has done a remarkable job over the last 10 years in keeping a handle on inflation. They've recently begun to increase interest rates, and what we've got now is this trade-off between whether or not we halt interest rates and let inflation and wages increase, or whether we increase interest rates to stall inflation rates with the likelihood that wage growth slows. And so those of us who want to see our wages increase are somewhat frustrated with what the Fed is doing right now, but the Fed is looking longer term, trying to make sure that we don't have more severe problems with the economy. This is an interesting graph I came across, and again, it shows a longer term than what I'm talking about today. But if you just look at this gold circle over here on the right, this is basically the last 10 years of growth in income, and it shows the share of income captured by the top 1%. And prior to the 2008 Great Recession, we were beginning to see a decline in the share of income that was being captured by the top 1%. And once the Great Recession hit and the recovery started occurring, the capturing of gains was captured more by the top income than by the bottom income folks. And so now what we see is that the top 1% is making about 26 times more than the bottom 99%. And I'm not trying to call for divisiveness in our economy or our politics, but this is a political situation that's probably not going to go away, and we're going to hear more about in the next few years. It's going to become something that more people are going to become more frustrated about, and unless we find a way to deal with some of this inequity, there's probably going to be frustration seen at the ballot box and maybe beyond that. Housing, remember that the mess that got us into the Great Recession was largely caused by poorly managed housing portfolios. And you can see here, this is the Case-Shiller housing price index, and it took a big hit for the first couple of years after the Great Recession, and by 2012 it had bottomed out and prices began to come back, and they are back at a high in 2018. So as far as the Case-Shiller housing index is concerned, the housing market has recovered nationally. If you go in and you examine the housing index regionally, you'll see that this varies regionally, and it's an interesting way to spend some of your time if housing markets are of interest to you, or someone in your family that may be involved in real estate, to examine this. But I won't dwell on it at this time. Let's go a little bit wider with our peeling of the onion here and look at agricultural trade. We were doing relatively well on exports and imports. The top line shows exports. The excuse me, the nomenclature is a little bit out of line here, but the top line is, the red line is actually exports, and the green line, the bottom line, is imports. And we were doing relatively well in the world economy as the Great Recession hit, but we lost export markets globally, and we stopped buying a lot from the rest of the world, so both took a downturn. But within a couple of years we began to swing up, and we broke records in both ag exports and ag imports by 2014. And if we push this out to forecasts for 2018, we'd see that both of these have gone down for 2018. It remains to be seen if that actually occurs, but the trade situation that the Trump administration has initiated with tariffs has put a big question mark on what trade is going to do for agriculture. And so it's really hard for us to look in the crystal ball and predict what's going to happen there. We can talk about it if you want to, but a lot of uncertainty there. Global banking has changed a great deal. If you go back to just before the Great Recession initiated, the top 4 banks in the world were owned by European companies, and the top 10 banks were owned by 7 of them were owned by European companies, 2 of them were owned by Japanese companies, and 1 of them was U.S. Move forward 10 years, and in 2017, the top 4 banks in the world are owned by Chinese companies. And if you look at the top 10 banks, 4 are Chinese, 3 are European, 2 are U.S., and 1 is Japanese. So there have been major changes in the scene in global banks, and this is likely to see major changes as we go forward. And as we continue to argue with the Chinese about what they're doing to us in the economy, how they're treating us back and forth bilaterally, they are going to have more and more leverage over us if you look at this bank picture. So we might be a little bit cautious about what's to come and how we might be treated in the global economy in the future. Let's narrow the peeling of the onion down to agriculture. Net farm income and government support. Net farm income declined during the Great Recession. It quickly recovered and hit records in 2013, and we've seen this great decline that has put agriculture in this very severe situation that we're in right now, where we've seen net farm income cut by about half. So we're down around $60 billion at the current time. What I've done here is put government support in along the bottom, and if you subtract government support from the top line of net farm income, you're left with that gray line just below the blue line of what the market is providing farmers. I'm just going to go through these relatively quickly, and these probably pose questions that you would get better answers from your commodity experts, Kim and Daryl, and some of your area economists from, because I don't focus on commodity markets like they do. But agricultural budgets did go through this inverted U during this last 10 years. We saw an increase in prices received during this period of time, but we're primarily paying more than we're getting paid for commodities in general. If you look at crops, it's been relatively straightforward over the last several years. If you look at livestock, we had the big bubble in the 2014-2015 period, and it's declined since then. You'll have to ask Daryl if he thinks there's about to be a resurgence there. And then you can just kind of pick your commodity of choice here, where you look at wheat in the upper left-hand corner, cotton in the upper right-hand corner. It's one of the few that seems to be moving in the right direction. Cattle in the lower left-hand corner, and food grains and oil seeds in the bottom right-hand corner. Like I said, I'll let you look at those on your own. So I kind of raced through those, and I can kind of go back and answer some questions here. I see Dr. Kuhn had a question about some of the bubbles. And I'm not sure which ones he was asking about the consistency on. So I'm going to go back here and see if I can get to the total employment. Let's see. The total employment job loss graph. Okay, I see what you're talking about. Um, this picture was basically in the first year of the Great Recession, and as the bubbles began to expand out, they moved out from there. So this was a pretty temporary, finite snapshot of what was going on. I'm not sure I can say much more about that. I'm sorry, Dr. Kuhn. This was in 2008 and 2009, I think. Shannon's asking about interest rates rising. Should I buy a house before interest rates skyrocket? Let's go to the interest rates graph here. Yeah. Um, you know, you can read what you want into what the Fed says and does. Um, what they said and what the gurus that listened to them say indicated that they didn't sound like they wanted to raise interest rates much more than perhaps once or twice more this year. So if you take them at their word, you know, interest rates are probably likely to stay under that 3% range, and you could add a percentage onto that for commercial rates probably. But if you are looking at investing in something, you probably where you want to get a good interest rate, I would guess you probably want to invest sooner rather than later. You know, but if they see the economy starting to go in the tank, then all bets are off, and I don't know what they're going to do. I'm sorry I can't get you a better answer, Dr. Kuhn. I will get you one. There were pockets where we lost jobs and didn't get jobs back, and I'm not sure if that's what this was talking about, but I'll just have to investigate this and get back to you. I agree with you.
I'm not seeing any additional typings. Go ahead, Larry.
Dr. Scheidler is and I are working on expanding this to the state and county level, and we hope to have something more in the next month or so for that. So we'll try to drill down to that when we have that available. And I don't want to pin Dr. Scheidler to the wall on it, but I think he could probably give us a better answer on that. Dana Zook was typing something and I don't see it. Did you decide not to type something, Dana, or are you still typing?
Anything else you want to bring up, Larry? I don't see anything else being typed in.
Okay. Okay, Dana's sending an email, so. Okay. Well, I hope this has been of some help to you. Our area economists, I think, can probably provide assistance on a lot of this. I don't want to set them up, but I'm happy to come out and talk about this to anybody that wants me to talk about it. If the area economists want to, I can work with them to do any of it if they want to. We'll continue to work on it. So thank you all, and I'll take questions offline through email as
we greatly
necessary.
Appreciate your time this morning, Larry. I'd like to thank everybody for attending, and when our next workshop comes up, I will be sure to let everybody know via email. Until then, thank you very much, and this thing will be recorded, so in case you want to go back and look at it again, you're more than welcome to. Thank you.